Hey investors, it's Stuart Cruz with Cruz Asset Management, coming to you with Cam's chart of the day. And today we're going to be talking about growth versus value. And what I have up on the screen right now is the Russell growth versus Russell 1000 value difference. And this chart starts in 1999. So as you can see, growth has outperformed value by almost 26% in 1999 and did so to a lesser extent in 97 and 98. But after that big run by growth, what we saw was a return to value investing. So in 2000, 2001, 2002, value outperformed growth. And you continue to see value outperform growth all the way up until 2006. So for the better part of the next decade, after growth had its heyday, value outperformed. You had a couple return to growth numbers pretty much flat for a little while the market found its footing. Again, a growth and a value. But now, looking at the last 5 out of 6 years, growth has outperformed value pretty significantly. And then you have a large run up again of growth outperforming value by over 26%. And again, the last time this happened, we saw a bunch of value outperformance. Now we're starting to see a little bit of those signals when Netflix had earnings yesterday, where the earnings actually beat expectations, but their forward guidance and call it the whispered numbers fell short. So even though Netflix outperformed, it dropped by 12% in overnight trading. And you've seen a lot of the other tech companies kind of sell off in that possibility of growth being replaced by value or some sort of sector rotation. Now that said, this interest rate environment generally definitely lends itself towards more of a growthy environment. So back in 1999, where you had that last incident where growth was pretty frothy, the 10-year treasury rate was trading between 5 and 6%, as you can see right here. So what that means is, if people are trying to invest money and they are borrowing at 5 or 6%, then they have a hurdle rate of their investment project needs to at least double or possibly triple those kind of numbers. So maybe it had to hit 15 or 20% projected annualized returns in order for those projects to actually be worthwhile. But right now, as you see, the interest rates have declined over the years and have come down to 62 basis points. Right now, I think my face is probably covering that screen, but it's at 62 basis points right now. That means the borrowing costs are next to negligible. So with all the money out there in the system, the hurdle rates of people making great returns are much lower than what they were in 1999. So that would suggest that this interest rate environment would lend itself to a much more growthy investment thesis, if you will. So until we start seeing interest rates move up, it's probably going to have a growth over value event. That said, growth has been very, very expensive as of late. So as I pointed out yesterday, Apple's PE ratio was trading at, basically twice what it had traded at in the past on average. So I'm going to tick on Apple here and go look at its PE ratio. It's trading at 30 right now. And if you look over the period of time, it's basically been roughly at about 15 or 16 on average. So here its PE ratio has really skyrocketed quite a bit. Okay, so even if Apple just returned or Netflix returned to kind of an average PE ratio of 15 or 16, that stock would get cut in half for no other reason than it's returning back to kind of a normal valuation level. So we've been seeing a lot of growthy names start to come off, and perhaps it's going to be a little shift or a little reversion back to the mean. So stay tuned for this. We'll continue to watch the trend. And this is Stuart Cruz from Cruz Asset Management signing off. And just remember to invest with the odds in your favor.